Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. I mentioned in one of our recent episodes, I've begun doing a rerun of Seinfeld. Still haven't got to the one where they pitched the show about nothing, but just makes me want to do think about all the bloopers, and I guess how they apply to what we do at our jobs as well.
That's right. And I mean, Seinfeld plays in the 1990s. It was a wonderful world because we did not have social media. And
Or even cell phones.
exactly. And part of me yearns back to a time like that.
Mm-hmm.
But on the other hand, we don't have to pitch to anyone in order to produce our own show about nothing. So, it's give and take.
Absolutely. Yeah. Hey, something interesting I came across, I believe it was earlier this week or maybe last week. I don't know if you saw this. So there was someone, I guess let's call them a participant in the construction ecosystem, right? Maybe construction tech, maybe just construction on its own, right? Who presented this point of view that funding in construction tech had dropped year over year from 22 to 23. I think there might have been stronger adjectives thrown in there to just intensify the extent of drop. I don't remember, but that opinion was presented. Is that something that how do you react to that? I mean, I have my opinions as well, but would love to get your reaction to this.
It's a great trigger. And so we want to talk today about the funding environment for founders in AEC technology, which, to a large degree includes the Constru-Tech and, the environment that they meet, but also like the tips and tricks and hints, how to make your fundraising in this environment, maximally value creating for you. And so that's a great trigger for that. So if you lead me in with that question, I have to say, I don't know what numbers that person or that team used, but it certainly wasn't the factual numbers. So we ran an analysis as recently as just 3 months ago, where we actually see that the AEC technology sector is increasing in funding and also accelerating in its increase in funding. It's not dropping. The funding round sizes are increasing. Average and median actually valuations as a result as well since 2021, and they are much higher than before 2021. Why do I exclude 21? Well, because that's the peak of the peak year, yes. and that year has no statistical meaning other than I don't know if the balloon popped, but we reached the peak of the mountain for a while. So let's exclude that one. But before and after, it looks very solid for Constru-Tech. Now, where it's harder are some of the stages. Where it's harder is perhaps some of the geographies. Where it's harder is perhaps some of the models that you try to raise for, and that's what we want to work through today.
Yeah. I'm glad you brought up the point on geographies. I think we could perhaps look at it from two angles, right? One is the hard numbers. The other is perhaps a more anecdotal or qualitative view into this. I think first things first, and if any of our dear viewers or listeners, if you've also come across this article, I would urge you to check if the basis for the assertion made in that piece is it primarily biased or centered around US or North America funding data, or does it take in a more complete source of information, right? This is something which, and we've made this point, I think, in at least a couple of our prior episodes, but it really takes some working to get around the fact that a lot of this aggregated information in VC in construction is often presented as, hey, this is the aggregate number for global activity and so on, but it's almost entirely US data, including the companies brought up as anecdotes. So you should perhaps, if you have read through this and it is causing you to double think or wonder about the future of construction tech, maybe pause and wonder if it's representative of who you are and what your business is doing. And also, is that even a valid way of presenting a finding? And I would say if we switch around to qualitative stuff, right, or anecdotal stuff, it's quite interesting. I think so. Numbers paint, of course, a certain picture. I would say what we are also seeing in recent months is very, very large firms, right, clearly making demonstrating intent to get in by making big moves in AEC as well.
Mhm.
I would say that, um, if anything, I would say is a leading indicator of what's to come for this year and presumably in the further along in the near future as to very meaningful funding rounds, maybe big ticket acquisitions as well.
One of the, I mean, um, perhaps a quick reaction just in general. If you want to know where a ship is going, the best way to see that is to be 10,000 feet high and look down, right? But if you want to know how a ship is running, you need to be in the engine room, right?
Yeah.
And so this is one of these things, is you can't take only the abstract view in order to conclude what is happening right now in the industry. You have to be on the ground. You have to be talking to the founders. You have to be thinking about investments. You have to be talking to other investors. You have to talk to acquirers. You have to see the IPO market and have an ear on the rail tracks there. So that's being in the engine room, right? And so that's very anecdotal. But once you have enough anecdotes, it actually, it gives you the picture of how the ship is running from the engine room. And so to that point, let's start with the first anecdote here. So what you just said, Shub, huge tech PE investor, absolute, I mean, Champions of the Champions League,
Mhm.
has reached out cautiously and silently to several of our portfolio companies who operate in sort of the same space of
Mhm.
AEC technology.
Mhm.
And all of a sudden signaling, oh, we want to make one, if not more, growth stage bets into the space and perhaps into exactly these companies. And this is an investor that is managing. Let's ballpark it as 50 billion.
Mhm.
It's not exactly the number, but to give you an idea,
Sure.
super high professional, and historically has done nothing.
Mhm.
Nothing in this space and nothing actually in this space at that stage even, right? And so what that signals you exactly is what you're telling me, is that investors have used the time to actually scout out which sectors they want to deploy in, and Constru-Tech is at the top of the list for people that manage a lot of money and seek and are committed to deliver high returns.
Mhm. So I think another important thing to call out here, I mean, which obviously resonates with something we've been saying quite a lot about, is what we heard from this investor was also that, in their opinion, I mean, a large part of their thesis is that a lot of incumbents in AEC, they've had this entrenched position, but for various reasons, for the lack of enabling factors, the timing was not quite right to build challengers to disrupt or replace these incumbents. But now, for various reasons, right? And it's too elaborate a piece to go into the enablers, and we have discussed that in other episodes, so feel free to go check them out. But for a host of enablers coming together right now, we kind of find ourselves in this brilliant situation where now it seems like it's the perfect time, or the start of the perfect time to create a new replacement or disruption to the incumbents, and that's
Yeah.
the thing they're getting behind.
Yeah, and look, I mean, that is driven by technology that wasn't around 5 or 10 years ago, and definitely not in the sector
Mhm.
around 5 or 10 years ago, um, as well as the fact that many customers are actually actively looking for solutions in a down market, in an underutilized market. And then finally, also the breed of founders in this sector that entered from other sectors who tasted prior successes, etc. That's completely game changed, and the VC, the venture capital available for the early rounds, and then as you see by anecdotes like this, also for the growth rounds, we see that it has 6x over the last 4 years only, right?
Yeah.
So 5 years more, but But so what you see is that historically, all of that was not available. So, much more difficult to make, big outcomes happen.
Mhm.
That's different now. Talk to me, Shub. Let's perhaps also walk founders that listen to this in Constru-Tech. I'm sure many of them are meeting their own challenges and adversities in fundraising, and others find a lot of immediate success even in the current market.
Yes.
Let's perhaps walk through a little bit. Perhaps we start with models or topics, then we go into the stages and then into the geographies. What are we seeing in the engine room of the market, and what can founders take away? How can they act? What are the tips and tricks? Start me off with the models and themes here that perhaps you see relatively easy to fundraise for, and then models that are a bit difficult to fundraise for right now.
Okay, interesting question. So I would say, starting at a very high level, if you as a firm can position yourself as a AI firm or an AI-led firm where you're either building your own models or your own source of truth through trained models, or you're sort of creating the next level of linkages where existing pieces of software or some enablers to that piece of software can interact with engines like GPT and the others to sort of parse through information. I would say, in the relative scheme of things, those kinds of models are amongst the most popular right now, not just in AEC, but in general, but also very popular in AEC. I mean, I have a theory or I have a hunch as to why that is the case, but we'll wait on, maybe we'll wait on that for now. So we certainly have an opinion that like a new firms which are creating the new tech stack for design and enablement of the common data environment in AEC. That's also something which is extremely popular
Yeah.
right now in AEC tech. On supply chain solutions, I think it's a mixed bag and a slightly nuanced answer from my side, in the sense there is demand, but if you prove profitability at some sort of scale.
Aha.
So I think once you prove either profitability or a very obvious path to access profitability, and again, just to recap, what I mean by profitability is not gross margin profitability, right? Well, important to call out, because I think everyone interprets them in a very convenient manner. It is EBITDA or net profitable at a net income level. If there is access, then it opens up access to an entirely different group of investors who are perhaps unaddressable otherwise. But I would say, in the absence of clear visibility to profits, a lot of supply chain oriented solutions marketplaces are finding it a little bit tougher right now. Not that doesn't mean it's a bad time to do those businesses, but there are some headwinds when talking to, let's say, the average VC, right? A lot of other ideas come to mind. Let me pass the baton to you for other models and a commentary on them.
Yeah. So very similar in the Western markets that I have a strong view on to what you said. I think the profitability around supply chain models / marketplaces or transactional models, directionally the same here in the Western markets, US, Europe. Let's say the scale of implementation of expectation from the investors is perhaps slightly different. Over here, you can already demonstrate or come to a great fundraise at a great valuation, speedy time. If you demonstrate, let's say, on a marketplace type model, 7 to 8% contribution margin after logistics, marketing, and sales. That will be something that people over here, even if you're not net profitable and you're burning on engineering, which is below the contribution margin, will be very, very excited about. I have several anecdotes of that of the last 12 months. But at a scale that is, let's say $1 million a month. Before that, it's mostly a product investment or like a team bet that you're taking. I think what has cooled down significantly, and I'm loving it, because it gives me like a like the advantage to buy something very vertical before generic investors catch up again is fintech. So fintech has seen, I think, generally a very tough time. We'll come to the stage point later, but especially later stages as well. But at least you have some if you have some infrastructure scale and play at the growth stage, you probably will find funding in fintech, perhaps just not at the valuations that you would like. But fintech early stage, I think, is very, very tough in general, and it has been tough for the last year or so. Also in construction tech, and I'm loving that. I'm loving that because there's try to convince me of the opposite. I think there's no differentiation in fintech anymore that anyone could find on a generic horizontal model. Tell me what it is. I don't know what it is. I mean, almost all fintech is just distribution games anyway. Some of them were interest arbitrage. And then what else is the value creation in most fintechs? There's usually not, if you go into insurtech, that's a different discussion, but in fintech, it's tough unless you actually verticalize and you go into a large enough vertical in which you fix other problems. For example, underwriting problems. Many people have, I fix underwriting problems. No, you don't, because usually the data available to underwrite either a transaction, a customer, or a good, that's the three things you can underwrite. The data is typically good enough unless you look into construction. And so that's something that the general recession of capital to fintech, which also hits perhaps founders that do fintech in this really cool sector, I'm loving that because that means that we can actually be ahead of the curve, we being the founders as well as us, to build cool fintech companies very early in construction. And so that's something that I think is actually, if you frame it right, but you frame it to vertical investors who understand the singularities of your sector, the peculiarities of your sector, and they judge you for what's peculiar. They don't judge you for being fintech. You can actually do a good fundraise right now in that space.
Yeah, absolutely. Absolutely. I think it's important to remember, even though as I guess alarming or depressing headlines of the kind we alluded to may seem, what you're actually building for is not fundraising activity in 2023, right? What you're perhaps building for is fundraising activity for the next 5 years, right? Or 10 years, right? And I mean, there's another point altogether. Perhaps you're building just for one VC round. Have you heard of this as a new paradigm? Firms which are now being built just to raise one round, and that's the only round they ever raise.
Not yet in my part of the market as much, but that's also because my part of the market is bred by people who have a lot of dry powder to spend and don't have enough targets to spend it on. But explain to me what it means.
So an interesting thing I'm seeing, which fascinatingly is being offered as a framework, both by VCs I come across as well as founders who volunteer this, is to make a case for why this particular round they're raising is going to be the final round that they need. They may opportunistically raise more, but this is going to be the final round they need. Now, I'm not saying I subscribe to that line of thinking, but it's an interesting evolution of how market forces, different sort of constraining factors have led to this sort of a discussion.
Yeah.
I have to say, even though I don't fully subscribe to it, I like where this could lead in terms of breeding a new kind of founder. My hope is that it creates a situation where founders actually sign up to build a business with, hey, this is the only VC round I need, and I'll just see what happens along the way.
Yep.
Rather than I bake in such enormous expectations and I know how to play the game, right? But because my demand side wants me to say certain things to convince them that this is the only round I need. Therefore, I have mastered the game of saying what I need to do. So that's my fear, as in all these cycles. And it's important for us to remember, and it unfortunately affects both sides, founders as well as VCs. We are in a cycle. And now when we are in a down cycle, hey, there might be ways of mastering the game in a down cycle as well, when you know what the other party needs to hear or wants to
You know,
hear.
there's a very, very optimistic subliminal message that I just want to make sure gets elevated from what you're saying, right? And this goes out to all the builders, geeky founders, product people, business people who are just great at building businesses and operators, but who perhaps feel like, oh, my communication has never been appreciated, or I don't have the logos that VCs appreciate. So this is the optimistic implication of what you're saying, Shub, to those people out there, is that right now, if your business is just a great business, it's a great technology, but perhaps, you know, you don't communicate the same way that someone from an Ivy League school and this consultant in the background or whatever, perhaps you don't, and that's why you didn't find as much success as some of the other people, and frustrates you in 2020 or 2021 because money got thrown after those people. That's a different time now. And
Yes.
so if you can just highlight how your business is great, perhaps it's net profitable, perhaps it's a business that has a fantastic working capital cycle, perhaps it's a business that has an insanely efficient sales motion based on community dynamics, or whatever it is, just highlight that and make it very vertical. Show how that is differentiated to a large enough market within you address very specific stuff. And if that's how what you communicate, but perhaps you're not the most or not the greatest speaker on the planet, it will get appreciated in the current market.
Yeah. For more details on what that entails, you should definitely check out episode 22, which we have on category creators.
Aha, yes.
Where we go into more detail on what the mindset needs to be, both from the founder side as well as the investor side, in building such a business.
That's right. I would say on top, since we're thematical, before we move on to the stage piece, so robotics is an interesting one, especially blue collar robotics. I think it's appreciated by a part of the investor market or the fundraising market, and another part not. But that part that appreciates it looks for it like crazy right now. I'm one of such person in the Western market. And then there's other investors where you can bang their door with the greatest technology, you will never get them across the line on a robotics play. So that's a little bit the insane part for founders who perhaps are not as plugged in or don't have as much fundraising experience but building robotics companies. You have to filter through a little bit, and a good angel or a good early investor can help you filter and curate that list so that you get to those who actually actively invest in robotics. But those who do, like us, they look for it like crazy.
Yeah indeed. Hey, but coming back to, I guess, what does the funding environment look like? I mean, we also made a few predictions, of course. I think it was episode 18 or maybe 19 or 20, where we made predictions about 2024. But zooming out a little bit, what do you think actually the trend looks like from 2023 to 2024 to 2025 for funding in AEC tech?
So look, I think on a stage level, pre-seed and seed has been liquid even since 2021. What came down came up was the dilution. What came down was the valuations that founders could ask for. But if you wanted to raise, you could raise on a good, business, or on a good plan, or on a good team. And I expect that to continue to be the case. If anything, probably in Europe, the valuations I would expect to stabilize a little bit in the early stages. I don't think they will come down because there's just too much capital chasing too few good opportunities in Europe.
Yeah.
In the US, I expect them to come up again because it was a really good buying market for early stage investors in the last 2 years.
Yes.
I do think, and it's certainly my hope, that we don't go back to the crazy days of like 3 or 4 years ago, and certainly we won't participate in that because that was unhealthy for everyone,
Yes.
and that it didn't allow you to build sustainable category creators. So that would be, yeah.
Maybe we dwell on that a little bit. I mean, what we have actually seen with some of those firms which raised at extremely frothy valuations from, say, 3 years ago or earlier. What has actually turned out with some of those firms where there's actually not enough to justify those valuations?
whatever side of the argument you want to take, you will find examples, like a small set of examples that justify your argument.
That is
So
true.
you will probably find, a number of companies where you say, hey, they raised a lot very early and quickly, but they did grow into it. Sure. But ask anyone in the investor community and ask any experienced founder that has been building companies for 15 or 20 years, you will probably hear the exact same sentiment, is that there was so much shit getting funded. Excuse
Yeah.
my French.
Yeah.
And so, we've seen companies run out of cash. Granted, I will say, Shub, I don't know what your take there is, but fewer and slower than I had expected. I actually thought that more companies that had raised a lot 2 years ago would already be in distress in the second half of 2023. And it certainly was, but it wasn't to the degree that I expected, which to me only means it's probably going to happen now. I don't know what you.
Look, I think it's human psychology that no one wants to hurry to deliver bad news. I think the bad news is in the way, but no one wants to be the one to announce it. So it's imminent, right? And if it's being delayed, it's not being delayed because it's going to be the beginning of a situation that is being remedied.
Yeah.
The more it gets delayed, it is going to be the final piece of news, or the probability that it'll be the final piece of news increases. So that's what I feel is happening with many of those situations, right? Just to dwell a little bit on what you said, the really fascinating thing I've been noticing in the last few months, which is again something I think maybe I've just heard in one other phase in my career before, maybe around 2016 or 17 or so. A lot of founders who've been around the block, either as experienced professionals or prior founders, in their earliest rounds are now saying things like, hey, it's okay. I don't want to actually raise at a high valuation because it's
Yes.
important for me to deliver a meaningful, not order of magnitude necessarily, but a very meaningful step up in the next round.
Yes.
And I don't want to create a big hurdle for myself.
Yes.
You would never hear that in 2021.
No.
Never.
No.
Right.
So
And it's quite fascinating that I'm glad that sort of thinking has I was about to say seeped in, but I mean, why should it be seeped in? It's very natural. I mean, the best outcomes in venture always happens where everyone compounds on themselves over a period of time, and you don't create unnecessary pressure to sort of grow into a valuation or an amount of money that you have set for yourself.
I'm hearing and seeing the exact same thing. 2 anecdotes from just the last month. So we have one portfolio company who just signed a massive round with their dream investor, really a dream investor for them. But that dream investor offered 40% less than the other term sheets were on the table. And the founder's argumentation, apart from getting to work with a dream investor of theirs, it was that, hey, actually, it makes a little bit more sense for us not to be under constant hurry to grow into something much larger. And I respect that. Other founders would have perhaps taken, and for sure 3 years ago, many founders would have taken a different view. And the other one so there's a unicorn founder over here in Europe that I very regularly do stuff with. He oftentimes has founder teams around him that he guides and sort of nurtures a little bit into some directions. And every now and then we speak and I give him some directions I find interesting. And so we had such a collaboration recently. And one of the founder teams that I and him, we had nurtured a little bit into a specific direction that we liked was what was then also asking for, a pre-seed fundraise with us. And so I asked him and I said, hey, what are you advising the guys to do here? Because I don't see something crazy happening. And then he opened his kimono as well. And he said, look, I mean, I've built this one company. Now I'm building the second company and very successful at it too. And he says, I tell all my founders that I work with is go for small valuations, go for small rounds, prove the business, and then keep building. And it doesn't matter if you lose 10% of ownership along the way. What matters is only the share price at the exit. That's the only thing that matters, right? So if you can compound so his point was you can compound your share price way more easily than you can actually make value out of controlling another 1% or 2 of dilution. So really his mindset is when you look after dilution for like decimals or even 1 or 2 percentage points, it's
Yeah.
already a downside protection mindset.
Mhm.
And that's the wrong thing to go into venture with. If your plan A is venture, your plan A is to go big, and then it's about the share price, and that's where it compounds.
Yes.
I love that. And I think it's exactly the right mindset. On the other hand, before I hand it back to you, Shub, I'm also seeing anecdotes recently in the last 4 weeks that I think, oh, we're already in a new boom and bust cycle. So let me
Yeah.
give you two, right? So number one, Mr. WeWork wants to rebuy WeWork now. I mean, talk to me about like the most. No, I will not say that. I don't want to get sued now. But news number one and news number two. This was in my LinkedIn feed today. This was not Constru-Tech. This was another space.
Mhm.
Was literally a VC firm posting on LinkedIn, hey, we've raised 5 million as an inception round for one of our companies, and now we look for a CEO.
Yeah.
And I'm like, what is happening? Like this is 2021 all over again.
Mhm. I mean, yeah. Was it an AI firm? If you remember, the the
Well,
the one where 5 million was raised as pre-seed.
let's hope, because if it's not AIM II, then it's even worse.
Oh gosh. Um, Look, I mean, a lot of these things happen. I mean, even you mentioned last 4 weeks. Even in the last 4 weeks, I've had a situation with a firm where, for some reason, even in a situation where I would describe the round was happening at an, in my personal opinion, a very expensive valuation, there was still an unusual amount of chatter over what stakes go to whom and stuff like that. In a way where I felt there was too much slicing on hypothetical future rounds and scenarios being built, etc. Look, all of that may play out, but I just want to call out to founders thinking along those lines. What if those scenarios don't play out? Right?
Exactly.
Who's going to be the bag holder? I can tell you one thing: if your scenario, the way you planned your scenario is that the investor is going to be the bag holder, that may play out. But then either don't count on an investor lobbying for you in the future, or if you don't if you want that investor to be lobbying for you, then the investor is not the eventual bag holder. Someone else is going to be the eventual bag holder.
To that point, so we have a portfolio founder team, super accomplished. Sold a previous company for almost $1 billion, and then went on to build in Construction-Tech. And that founder is, I want to say, early 40s, lots of life experience, lots of business experience. And that founder struck me. That we went to dinner perhaps a year ago, and we've invested many years ago into that company, 3 or 4 years ago. And so he shared a philosophy with me where he said this was about some hypothetical secondaries in the future, or hey, what happens if a down round happens? Some scenarios like that. And so he goes, I will take the bite, I will take the heat on all of that, and will protect my existing shareholders, because he said verbatim, I want to be known as someone that you can do business with. My reputation to me is as important to you as a VC. That's someone you want to work with. That's someone
Yeah.
you want to partner with. And by the way, if someone then approaches you with exactly that mindset, what do? You reciprocate. If
Yeah.
it comes to that, you will make sure that person actually doesn't have to eat it on their own, because you're actually feeling the partnership.
Yeah.
You're sharing it. But it's the backbone of such a person that you feel like, okay, I can do anything in a
Yeah.
partnership with them.
Yeah. Yeah. I mean, uh, I'm not at liberty to share details, but there's another situation within our portfolio where I thought the founders really went out of their way to do just that, right? Eat into a difficult situation to make sure everyone felt very good about what's happening.
Yeah.
And I really am very grateful to those founders, in case you're watching or listening to this, but also in general, people who stomach these situations to make it up to their investors.
Now we've gotten a little bit off topic here now with going down this rabbit hole. So let's bring it back perhaps to the current funding environment. What can I do? Talk to me about the stages. Let's say early stage or growth stage. What's the environment looking like, and what should I do?
Look, so I think early stage is the interesting one where the answer varies enormously based on either who you represent in terms of your founder profile, what space you're operating in, and the nature of your business, where the experience varies very widely from, hey, it's super easy for you to raise a relatively large or obviously large pre-seed round very quickly to you're having a very tough time putting together 1 million, right? Which is why it's quite hard to generalize, I have to say, and it's quite fascinating that that has to be the case, or that's the range we are talking about for pre-seed round. I would say anything later than a Series A, and for the sake of oversimplification, let's say from Series B onwards, my experience is it's uniformly tough for everyone,
Yeah,
right? There is no, oh, superstar founder gets a easier time. No. So
you're
everyone
right.
is brought down to the lowest common denominator. Everyone needs to match the most stringent standard. If you don't clear the most stringent standard, there's not even a meeting, there's not even a start of a discussion, and that's the end of that. If you meet the most stringent standard, then you be mentally prepared for the start of an exhausting multi-month, maybe multi-quarter process.
So what do I highlight then? So let's say now I'm in this growth stage in Constru-Tech. How do I get funding?
So, okay, so a few things to keep in mind. So there's many investors out there who are right now not even interested if you're not EBITDA profitable or net profitable, or have visibility to get very close to it fairly soon. So if you think you're more than uh, push comes to shove, if you had to turn EBITDA profitable, would you be able to do it within 6 months? Right? If not, assume that a very large number of growth investors will, even if they take meetings, they're not taking meetings to actually sincerely evaluate the opportunity. Oh, by the way, not to get distracted, but that's another thing to keep in mind. Hidden secret, which I think all VCs know, but no one's going to openly admit it.
Aha,
A lot of VCs right now, including later stage ones, are very happy to take meetings simply because they're not doing deals. They
appearing
have way
busy.
too much free time,
Yeah.
way too much free time,
We did
right?
30 deals last year, just for the record.
Yeah.
Yeah.
But that's not reflective of the average VC, and
No.
certainly not the average growth VC. They have way too much free time, right? So it's more like building a network, building knowledge, or building information. I should say knowledge depends, but building up an information database to see where it goes. That is not necessarily reflective of a process that's moving forward, right? Yeah. So coming back to what I said, if you're not don't have visibility to either have significant runway, or if you're not don't have significant runway to get to a position where you're at least EBITDA profitable within the next 6 months, you're going to have a tough time. So maybe try to find a way to either show visibility to EBITDA profitability within the next 6 months, or find a way to dramatically increase your runway. Because if neither of those is true, you're probably going to have a very tough time raising a growth round, or may have to accept a very big cut on valuation.
Can I change the narrative of my company? So for example, I was in market A and I noticed that market perhaps doing okay, but perhaps it doesn't get appreciated by the investor market. Now I go into market B because perhaps investors are loving that one. Is that
Mhm.
is that a thing I should consider?
For a growth round,
Mm-hmm.
oof. Um, maybe. I think the only exception might be if you're in AI, select themes around, say, clean energy transition, stuff like that. So there, I think the bar is lower.
Mm-hmm.
Or again, cheeky answer, but the incentives are aligned differently. There's perhaps a different set of motivations driving those deals, if I could go to the extent of saying, right? Not necessarily because, you know, again, if I may take the liberty of saying, it's not necessarily that those deals happening in those spaces are of a higher quality. It's just that there's an entirely different set of motivations pushing those deals out the door. So if you're in one of those spaces, I guess good for you. So if I were a founder in those spaces, I'd probably make hay while the sun shines, right?
Although, by the way, my feeling is that actually has receded a lot in the last six
Yes,
months.
exactly. Because so I was going to say make hay while the sun shines, because it'll probably not last for too long, right? So if you're there, so the clock's ticking, so you better get to it. If you're not in one of those spaces, um, I think it's feels homogeneously barren. I have to say.
I mean, pivot into a different market. So if you're a horizontal play and then you verticalize, yes, that I
Okay.
would say can generally work, but it will be very tough to go from a horizontal play into a construction specific play, just because of the number of singularities that construction has, which are very, very different from all other sectors. So verticalize into other sectors, worth considering. Verticalize into construction after you have whatever built for 5, 6, 7 years horizontally, and you're under cash constraints, you're under runway constraints. Ooh, that I would not recommend someone.
Yeah, yeah.
Mhm.
So if you're on a growth mindset, the very first thing to resolve is you need to be on a situation where you have at least, worst case, the ability to extend your runway to at least 2 years.
Yeah,
If a loan does not happen soon, like on your by the firm by itself should be able to last for 2 years.
yeah.
It will be big sacrifices, but if that doesn't happen, be prepared for either a fundraise that never happens or takes way too long, or an enormous compromise with
Now,
the.
two other recommendations I would have. So we've talked now about the growth stage side. If you're an early stage founder, let's say you're perhaps pre-founding or before your first round, and you operate in AEC tech / Constru-Tech,
Mhm,
and you find it hard to raise, although the market really is liquid, but
mhm.
it's never equally liquid for every model or every market or every founder type, etc. So if in
Yeah,
spite of all that early liquidity you find it tough to raise, here's two recommendations from me. So number one, if for example, you're building a marketplace or you're building a transactional business, you don't need to build a lot of product first, but you can actually begin building a business and then building the product alongside it. Bootstrap. It's an old school venture method. It's the most proven method out there. It's the best method to control dilution. And it's actually the best method usually that pays off long term
yeah,
for founders, hands down. And it's actually what investors like too. It's just that for some reason, this dump industry that we're in has gotten away from it and has created worse and worse incentives for everyone around us not to pursue that model anymore. It's the
yeah.
best model out there. So don't raise right now, just bootstrap if you're building a business like that. And the second one is, if you actually need to build a lot of technology or a lot of product, try to find a way to build service revenue
Mhm.
while you're building it and financing your R&D through that if you can't get an early stage investor, because the construction industry is perfect to deal with service type contracts. Now, this goes against any wisdom you will find on the internet by junior investors having loud mouths and talking about all their wisdoms of 18 months of investing and 0 months of operating, where they will tell you, oh, I will never invest in a business that has a service element, or, oh, I only invest in recurring revenue. Trust the people who have a bit of life experience and business experience here. Just keep building service revenue in the early days. If you have to, it's fine. You will not get punished for it, and it allows you to finance your R&D because you're in a sector where service revenue is extremely common and easy to sell.
Agreed, 100%, 100%. And I think one closing thought perhaps to add to this aspect. If you're not already in construction or you are not familiar with this dynamic, you may be surprised if you decide to take the old school services and relationship led sales method, how productive that is. And when I say productive, I mean quite literally, in the sense how much value per FTE or per employee or per person you can
Exactly.
generate as a firm. It would compare favorably against the best big tech firms out there.
Thanks for saying that. That's exactly what you would be seeing.
Yeah. So, and by the way, when you see that, it's a sign that you may be a category leader in a great space. So again, nod to our recent episode. But I think that is a way to unlock great ability to sustain yourself, proxies of customer love, etc., etc.
Exactly. Exactly. And it's a very good way to build track record, which is important in this industry. I can say throughout my career, I've never worked in a sector that values track record more than the construction industry, other than VC.
Mm-hmm.
So
Absolutely.
So actually, I think it's not a dire situation for founders at all. Certainly for growth stage founders, if you've burned too much, perhaps you don't have a sound business. Look, I mean, it's tough. It really is tough. But if you have a good business and then you're being pragmatic about it, and you have a path to net profitability very quickly, actually, it's looking okay for you. You just need to put that into the window.
Yeah.
If you're an early stage an early stage founder, just about to found, the market is liquid. And if it isn't for you and people don't get what you're doing, then bootstrap or service the hell out of it.
Mm-hmm. I mean, regardless of what the lagging indicators say, I would say focus on the leading indicators, and the leading indicators are very promising.
I agree.
Yeah,
I
for
agree.
AEC Tech.
We just founded a new business and raised $5 million for it, and now we're looking for a CEO. I mean, that's a leading indicator.
Yes, that is correct.
Oh man, talk to me about leading indicators in your calendar.
My leading indicators, it's actually still surprisingly similar to what I said in our last episode or thereabouts. There's one firm I'm looking at, which is again to do with, I guess, a software or led approach to solving for grids and the replacement of grids and what that
Nice.
means across the world. So it's not specific to one geography, but a global solution from day one. The other one I'm looking at is a much more conventional solution, trying to displace or replace a proven AEC tech leader, actually, but showing some signs of some of the things we discussed, like surprisingly good numbers with few people and few resources. So some of those dynamics are working in that firm.
Interesting. On my end, currently looking at a service titan for Europe and trying to figure out what market characteristics do you need to hit to rebuild a huge success that Service Titan is. So it's a very intellectually stimulating exercise. I'm not sold on it at all right now.
Okay.
But I'm sold on finding it out.
That sounds like a fascinating exercise.
It is. Yep. Yeah.
Nice. Excellent.
All right, sir. Well, it's not quite weekend yet, so we can't use that moniker, but have a great evening, I guess.
Yeah, have a great evening. I'll see you around.
You will.
I
Cheers.
will see you around.
See ya.
See ya.